Hello everyone from Hong Kong and welcome to the weekly market update. The S&P 500 is on track to surpass its old record high, and while it could see a shakeout around that level, technical strategists see a big move higher. A surge of activity in underperforming sectors as the tech rally finally stalls is helping lift the broad S&P despite tech's dominance. Technical strategists who follow charts say the fact tech has passed the baton to industrials, materials, transports, and others is a positive and makes for a stronger market foundation from which to move higher. So broadly, technical market indicators continue to be favorable. What does that mean? Well, in very basic terms, to perform a technical analysis, take a look at a graph for a stock or an index, add some lines, and identify trends. Right now, if you do that, those trends broadly look positive. So, can good technicals alone continue to drive markets forward? Well, the answer is yes, they can, and they can do so for a considerable period of time, particularly when the market has confidence that there is ample liquidity in the system. And the Fed and other central banks globally have made it very clear that they will continue to provide liquidity at least for the remainder of this year. Fundamentals such as unemployment and consumer sentiment, however, continue to show strain. A major concern is if we begin to see a further weakening of fundamentals going forward. Signals to look out for: capital impairment events. In other words, bankruptcies. These are long-term solvency issues that are not easily solved. If we see large-scale bankruptcies and long-term unemployment rising, these are things that would cause me to be increasingly concerned. These things are long-term structural change, which in the long term can be favorable, but in the short term can be very painful. Gold has historically been one of the ways to mitigate such risks, and we saw prices rise to record levels in excess of $2,000 before falling back. A frequent question from clients recently: is gold too expensive? Well, the gold price is being supported by both technical and structural demand. Other safe haven assets, such as treasuries, are less attractive as they yield close to zero. But as we saw this week, if treasury yields start to rise, gold can become fairly volatile. Gold demand is also being underpinned by long-term model portfolio allocations. As we see fund managers move from treasuries and government bonds, price targets by some analysts have been raised for gold to $3,000. And I think, like in previous gold price spikes, we have likely established a new higher base price, even though we may see some volatility in the months ahead. Let's touch on the elephant in the room, COVID-19. Will a vaccine be a silver bullet to the world's problems? Well, a usable vaccine likely won't be available to distribute en masse until at least Q4 of 2021. And even then, an efficacy rate of 50% will be acceptable to the FDA. So much like the flu vaccine, if you get the COVID vaccine, you can still get COVID. I think it's important to focus our minds on living with COVID, and we should look for strategies to mitigate the risk of the virus. And as the months go by, companies have and will continue to adapt. Some interesting sectors: masks, gloves, PPE, remote healthcare, remote working, cloud computing, and broadly consumer staples. On to the US election now. A common theme in conversations with clients lately: I want to wait until November. The US election, of course, has the ability to cause gyrations in markets. However, whether Trump or Biden prevails, we will still see opportunities. If Trump wins, we will likely see a forgiveness of the currently suspended payroll tax. In addition, a cut in capital gains tax, both of which will likely be stock market positive. In addition, China will likely be forced to make longer-lasting agreements on trade. Any certainty on the trade front will also likely be a positive for markets. Biden currently leads Trump. However, that lead has narrowed in recent weeks. And on Tuesday, Vice President Biden selected California Attorney General Kamala Harris to be his running mate. This appointment ticks many boxes, one of which being she becomes the first African and the first Asian American woman to feature on a US presidential ticket. If Biden wins, we will likely see tax increases, but a moderated trade policy, which may be of benefit to markets, as we see tariffs removed. An interesting sidebar on the election front, which caught my attention this week and gives us some insight onto the internal machinations of the Republican Party, involves the United States Postal Service. The US Postal Service will be more important than ever this election season, with mail-in ballots likely to be pivotal to the outcome. The USPS has just appointed a new Postmaster General, who for the first time was externally recruited. The new recruit happens to be a Trump supporter and a Republican Party donor, a move which has caused allegations of nefarious goings-on behind the scenes by the Democrats. Who wins? I think it will again be very close, and I won't give my opinion on that on this video, but if anyone wants to discuss that further, you can contact me through the usual channels. If anyone is concerned about the risks to US stocks as we approach the US election, remember there is a whole world out there. Look to Europe, emerging markets, Brazil and China, which may see some tailwinds from the recently weakening US dollar. Also look towards assets with downside protection mechanisms. Sector rotations may begin to occur, and we did see it earlier this week as the Dow Jones outperformed the Nasdaq. However, this trend has had many false starts, and lo and behold, it did fade through the close on Wednesday. Finally, cash is king. Well, is it? I continue to be of the opinion cash allocations should remain below 20% of your portfolio. And even then, I think that is a very bearish positioning. Cash is the only guaranteed way to lose buying power. Inflation, it hasn't reared its head yet, but it likely will in the year ahead, as the excess liquidity filters through the system as consumption returns. Central banks may also struggle to raise interest rates to control inflation if the broader economy remains weak. Of course, the older you are, the more cash you should hold. But younger investors should beware of getting caught in the cash trap. I continue to be a proponent of multi-asset investing through funds, fixed income, and alternatives. This is the proven way to reduce volatility in portfolios and drive longer-term returns. It's certainly been an interesting week, for sure, and I hope this summary has been useful. If there is anything you would like me to cover in the weeks ahead, let me know, and any feedback on the video and the topics is greatly appreciated. I'll be back at the same time next week. Thanks for watching.